What's up, YouTube? Herman Williams here again. Well, we finally made it through 2020, and what a year it was. While 2020 certainly created its share of hardship for millions of people around the globe, I think there are some things we can all learn from 2020 that will help us be prepared for whatever the future brings. I think there are definitely some things we can learn about investing from what we saw in 2020, and that's primarily what I want to focus on today. We should always be striving to be better investors and better entrepreneurs, and 2020 gave us plenty of lessons in each. Stick around, we're about to talk about some of those lessons and how you can use what we've learned to become a better investor. One of the biggest lessons that 2020 taught all of us is that nobody can see the future. Back in March, economists, politicians, and investors all had their own idea about the impact of the coronavirus on the economy, public health, and the stock market, as well as how society might have to respond. The how society might have to respond part was front and center on every investor's mind, and again, everyone had their own opinion on how that response or lack thereof might impact the economy and in turn the stock market. I myself remember back in March, I was on the Gulf Coast just starting to work on a real estate project when things started to get bad. I was in my RV, and the RV park I was staying in is owned by one of the local casinos. Well, I received a call at around 8:30 p.m. telling me that the casino and RV park were shutting down and I needed to be out by 10 a.m. the next morning. Now, I wasn't totally surprised because, like everyone else, I had been hearing of the rising cases and what action might have to be taken. Still, I didn't initially see it as a long-term problem. I guess growing up on the Gulf Coast and living through numerous hurricanes, I kind of view the situation as a hurricane evacuation notice. When a hurricane is projected to hit a certain area, evacuation orders are usually issued, and some people leave and some people don't. There's usually some level of death and destruction depending on the strength of the hurricane, and some people are out of work because their employer's business got destroyed, and some people choose not to go back to what they were doing before. But at any rate, after the storm passes, the rebuilding process begins and things start to get back to normal. And there's a certain amount of predictability that goes along with that. Things such as how fast will businesses be able to rebuild or repair so people can get back to work, and what will be the rate of recovery for the area that has been impacted by the storm. Well, that's what all of the so-called experts tried to do with the stock market in 2020. Back in March, these forecasters predicted that the 2020 outlook for the S&P 500, which are the 500 largest corporations by market cap that are listed on the New York Stock Exchange or the NASDAQ Composite, would only have a gain of about 2.7% by year end. Well, the S&P ended the year up about 16.2%. So much for forecast, right? Even if someone had a crystal ball and the knowledge that this country would be slammed with over 300,000 people dead and almost 20 million cases at year end, do you think they would have seen the S&P being up 16% after dropping over 30%? Probably not. The point is, forecasts, just like hurricanes, are unpredictable. That is why you should not let the fear of 2020 prevent you from getting started investing in 2021. Yes, there will be other storms, but if you start now, you will be giving yourself more time and more resources to better weather the next storm. The second lesson that 2020 taught us about investing is that the unthinkable can happen, which is a lesson we should have already learned. Back in 2008, we thought some banks and financial institutions were too big to fail, but they did. In 2020, as the virus was spreading globally and had even reached the U.S., investors still didn't get overly concerned, at least not until late March when the market hit bottom. At about the same time, the U.S. government stepped in with the CARES Act. Now, even though, as the name suggests, the CARES Act was intended to help struggling families and small businesses, Most investors knew that the majority of that money would go to prop up big corporations. So by late April, investors were already starting to get back into the market. It was like FEMA rolling in after a hurricane. It's supposed to be there to help those most in need, but someone always finds a way to game the system, and sometimes those most in need get left behind. No economic system is too big to fail, not even the U.S. The question is, how bad do you fail in a crisis, and how quickly do you recover? I think 2020 taught us that our system can fail, but it's also pretty resilient. The volatility and all of the craziness of 2020 also taught us that a long-held principle in investing is still a good strategy. I'm talking about what is known as dollar cost averaging. Dollar cost averaging is simply when you dedicate a certain amount of money to your investment portfolio on a regular basis, and you continue to dedicate that amount of money whether the market is moving up or moving down. One thing that we know for sure is you're never going to be able to time the market, at least not consistently anyway. Now, by timing the market, I mean you will not be able to always buy at the lowest point and sell at the highest point. At the end of March, the market rose and fell over 5% many times. So if you were panic selling or panic buying, you were likely doing it at the wrong time. The problem is you don't know what the low and the high points are going to be. If you sell because the market dipped and you're afraid it will go lower, the positions you just sold could turn around and go higher than they were before. Now you've lost money on both ends. The same applies to buying just because you see the price go up. You could buy it at a higher price only to then watch it drop 15%. Dollar cost averaging allows you to smooth out the bumps and gives you a better average price while keeping you in the market. Yet another lesson to learn from 2020 about investing is that rebalancing works. When the markets fell in late March, everybody's breakdown of assets moved as well. If you had, say, 75% in stocks and 25% in bonds or other safer assets, but the stocks got hit by 30%, you may have been left with only 68% in stocks, which would be far less than your goal. A rebalance after the crash would have led you to buy more stocks by shifting some of your assets or changing your allocation. This would have put you in a favorable position to enjoy the gains of the rest of the year. Now, if you had done that, you'd probably be more stock heavy now than you want it to be, so you may need to rebalance again to stay at your goal allocation. This is a good time to review where you are and make adjustments as necessary, so you start 2021 on the right foot. Another takeaway from 2020 is that despite how crazy the year was and how volatile markets were at times, history has shown that the markets will probably be bigger later. Over any 10-year period, the S&P 500 has only seen negative returns once. That was the decade that ended in February 2009. This is why dollar cost averaging is so effective. If you diversify your portfolio and keep putting money in at regular intervals, you will come out ahead almost every time. Look, if you're going to invest in the stock market, and in my opinion you should, you have to do it with the right mindset. Remember that you're investing for the long term and not for the moment. I will talk about some short-term investing strategies in another lesson, but just think about this for a moment. Despite all of the craziness of 2020, the S&P 500 ended the year at an all-time high and secured a gain of about 18% if you include reinvested dividends. If you had $10,000 invested in the S&P at the beginning of the year and didn't panic in March, you would have ended the year with about $11,800. Not a bad return in any year, but in 2020, that's something to take note of. The Dow Jones Industrial Average also ended the year with a new record high and was up about 7%. The NASDAQ had the strongest gains of the three major indices, With big tech and software stocks being the most popular during the pandemic, the NASDAQ ended up the year with a jump of more than 40%. I personally managed 3 portfolios for myself that I had a combined weighted average return of 49%. Now I also had a single stock mixed in there that was up over 134% and another that was up over 74%. The bottom line is that 2020 took a lot from us in the form of lost loved ones, lost contact with family and friends, lost wages, and even lost jobs. But what it gave us is a renewed hope that if we practice good behaviors when it comes to investing, we will always stay on track to reach our goals. So if your investing behaviors didn't yield what you thought they would in 2020, just remember what I always say. Change your behaviors and you can change your life. So until next time, behave well.